All right, I think we're live. If anybody's watching this, maybe it'd be helpful if you could just tell me if you can see this and if you can hear this all right. So I hope everybody had a good New Year's, and I hope you all came up with some good New Year's resolutions. If you're doing CFA, maybe a good one is to quantify how many hours you're going to study or something like that. So for this live stream, I'm working in collaboration with UWorld, which is one of the three biggest CFA prep providers. They've made a lot of the content possible on my channel. So what we're going to be doing is just walking through a lot of the equity valuation content in CFA Level 1. And what I really want to nail in on is that a lot of this stuff is pretty intuitive. So I'm just going to flip through some of these slides real quick to get to actually some of the meat of this thing. So obviously you guys already know information about me. And this is a little bit of information about UWorld. But with that, I think we should just get straight into some of this, the important stuff. So why did we pick this topic? Well, I think the important thing is that this is worth, especially with equity valuations, in particular CFA, this can be worth a lot on the test in terms of the percentage that's allocated to it, but it's really intuitive and a lot of the core principles are the same. So once you've figured out, once you can see basically the forest from the trees, the bird's eye view, it becomes easy. So what I would say is that basically valuation is just basically two things. And once you can figure these two things out, you can start intuitively understanding it rather than relying too much on formula memorization. So the first one is cash flows. So what cash flows does this asset provide me? And if we're talking about equity specifically, it's what is the dividends that this is going to provide me? And then what is the terminal value of the price once I get to my steady state? So we figure out our cash flows, and then we just need to figure out, based on the risk of this asset or this stock, what are the appropriate discount rates. So then once we have the cash flows and the discount rates, we're just taking the present value of those cash flows back to today. And then once we sum all those cash flows present values up, that's the estimated price or the intrinsic value. So once you get that down, everything becomes a lot simpler. So that's why I'm saying don't just memorize formulas. You should start visualizing the cash flows. And then once you master this and you can kind of see these cash flows as a timeline, the math all becomes more intuitive and you won't need to rely on memorization just quite as much. So while we walk through this, let's go with the idea in mind that while we could just use formulas, we should actually think about intuitively the logic behind what we're doing. So this first question I wanted to go over is not a quantitative question or a formula-driven question. It's just a logic, what is a qualitative question, I should call it. And so this is about the price to sales ratio. So which of the following is least likely to be a reason for using the price to sales ratio? So that's what that P divided by S is, basically a ratio of the price per share of the stock divided by the sales per share of the stock to value a company. So we want to find what's not a good reason. So this one says sales are generally more stable than earnings per share. So is this true or false? Well, we would say that this one is true. And why is that? Well, there's so many things that you can do to manipulate earnings, but there's not as much that you can do to manipulate the sales. So for example, let's say that a company has like a giant piece of equipment and they can only sell this equipment for a large gain one single time. Well, they could sell it this year, realize all the gain this year, then make it look like their company was really profitable this year, but they cannot do that every year because that's not a part of their core business. So the earnings was really manipulated by this one-off thing. That's just an example. And so because we're looking for least likely, and this is actually a true statement, we would say that's not our answer. The next one is sales numbers are less subject to accounting manipulation. And that one is also going to be, we would call it true. Now, why is that? Well, let's just give like one example. So a company can choose, say we stick with equipment. We're sitting there and we're thinking about the how do we want to recognize depreciation of the equipment? Well, with the depreciation, we can basically decide, do we want to realize more this year, realize more next year? And we can manipulate our earnings that way by pushing costs into different years, whereas the sales are just going to be what the sales are. So we'll say that one is not least likely. And then finally, the last one. Price to sales valuation methods can be used for comparing companies with different cost structures. So would this least likely be a reason? And we would say yes. And now, why is that? So if companies have different cost structures, let's put an example in place. So let's think about like a tech company, say like, it doesn't even matter. We could say Apple. Or we could look at, say, like a Walmart. One might have really high margins where, like Apple, say the margins are like 40% versus Walmart where the margins are like 3%. So Walmart might have a lot more sales than Apple, but Apple should have a higher price just because they can make more off of each sale. So the cost structure is different, which makes these companies not very relatable. Then I see one comment said, is C for enterprise value over EBITDA? I guess you could actually think of it that way, right? Because if you think of enterprise value, that's going to be the value of the company. And then EBITDA is telling you the earnings before interest, taxes, depreciation, and amortization. And that might apply the same way. Like Apple might look worse with an enterprise value to EBITDA ratio as well. So yeah, we got C as our answer. That's our first qualitative one. Now I want to get into more of a quantitative question so we can start like getting some of these formulas down. So let's just clear off some of this text. 1 second. There we go. Okay, let's move on. So yeah, we see I got our answer right. Here's a few things. I'll let you guys, if you want, when you're watching this later, you can also just pause the screen. But just a few things. I mean, we covered most of this, but the rationales for using the price to sales ratio is that one of them, which we'll get into in a future question, is that the sales are always positive, whereas earnings can be negative. So if you have a negative value in the denominator, then the whole ratio is messed up. That makes the whole ratio negative, which makes it completely unuseful to you. Also, the sales being less subject to the earnings manipulation. And sales are more stable than earnings. We said that already. So we'll get into some of these reasons as we hit another question in the future. So now this one is going to actually question whether we know the information formulaically. And this one does require probably at least some minimal level of formula memorization. So an analyst applies the Gordon growth model. So whenever we see Gordon growth model, as we do here, this is where we're talking about that long-term steady state where the dividends we expect to grow into perpetuity. So let's just really quick write our Gordon growth model formula, which says that the value, so the intrinsic value at time zero or today, should be equal to the dividend 1 year in the future divided by the required rate of return R minus G, which is the long-term steady state growth rate. So now as we go through this question, let's see how we can plug numbers into this formula. So they're using Gordon growth model to estimate the intrinsic value of company stock. The company has historically maintained an average dividend payout ratio of 30%. So that means of their net income, they pay out 30%. and they retain 70%. In the most recent year, the company reported net income of 11 billion, a financial leverage ratio of 2, and a return on assets of 10%. The most recent annual dividend was $5. If the current stock price is $142.50 per share, the stock is most likely, and then we need to figure out if it's overvalued or undervalued or fairly valued. So what can we put in here? So we saw the most recent dividend was 5. So that actually tells us the dividend today. So dividend at time 0. Excuse me. I came down with a little cold over the holidays and it won't go away, but we'll power through. So the annual dividend was just 5, but how do we get to the next year's dividend? So D1 is going to be equal to the dividend today times the growth rate. Do we know the growth rate? Well, based on all this information, it wasn't just given to us. So right now we don't have D1 and we don't have the growth rate, but we do see the required rate of return on equity is 18%. So we can plug this in right here at 18%, and then we need to find the other two. But to find this one, we need to find growth. So everything is about finding that growth rate. But we do have information that can steer us to the growth rate. So here's the formula for finding the growth rate. It's just the return on equity for the year multiplied by the leverage ratio. Or sorry, not the leverage ratio, my bad. The return on equity times the retention rate. And so we don't have ROE, but we have the dividend payout ratio. So what is the retention rate? Well, let me actually just write this down here. So retention rate is just the opposite of what we pay out. So what we don't pay out, we retain. So retention rate is going to be equal to, oh, sorry, I wrote this in a spot where you guys can't even see it. Let me write that a little bit higher. I'll write it up here. So retention rate is what we don't pay out. So it's going to be 1 minus what we paid out, which is that payout ratio, which was given to us, which is going to be 1 minus 30%, which leaves us with an amount that we keep of 70%. So now we need to find basically what is the ROE, because we have the retention rate. So ROE, there's basically a really easy way that we can do this, or there's a longer way, but I'm going to show you the way that makes more sense in my brain. So financial leverage ratio tells us that there's twice as many assets as equity, or as the amount of equity, because the financial leverage ratio is 2. And the return on assets is 10%. So that means if we have the same return for half as much equity as assets, then the return on equity will be double the return on assets. And this is a very simplifying formula that you can use for this, which says that ROE is going to be equal to the ROA times the leverage ratio. Right? Which makes intuitive sense. There's twice as much assets as there is equity, so the ROA should be half as much. So that'll be the 10% ROA that we're given in the question right up here, multiplied by that leverage ratio of 2, which gives us an ROE equal to 20%. Now, if we plug this into our formula, we're going to have 20% ROE multiplied by the the 70% that we actually retain, and that gives us a growth rate equal to 14%. And this makes sense because this is how much we return in a year on our equity, and then this is how much we actually keep from what we returned, and we multiply those two together, and that tells us how much we're going to grow our equity each year, 14%. Now, if we plug all this in, and I see some people are already getting the answer correct in the chat. Yeah, that's funny. So the dividend is going to just be equal to that original dividend of $5 multiplied by the growth rate that we figured out of, and I should actually say I wrote this formula just slightly incorrectly. Let me clarify that formula. So it's not times only g, it's actually times 1 plus g. So that's going to be equal to the 5 multiplied by 1 plus 14%, which is going to give us a value for the dividend of $5.70. So 5.7. So now we just plug and chug everything. We have all our answers. So it's going to be 5.7 over the 20% required return. Oh, sorry, it was 18% that they gave us for that. They gave it right in the problem right there. So 18%, and then minus that growth rate we calculated of 14%. And once we do all this math, what we're going to find is that this comes out to $142.50. And because they told us that's the current price, then we can say the stock's fairly valued, which was done well by somebody in the chat who beat me to it like a few minutes ago. So that was pretty good. And yeah, that pretty much does it. I'll show you with the longer answer. There is a different way you can do it without knowing that ROE to ROA leverage ratio formula. And basically how you can convert is if you basically have to figure out what's your total assets. So we knew that the net income was this value. So we knew the 11 billion, and we knew ROA was 10%. So if you divide the total assets by the return on the assets, you'll get back to this is the total amount of assets, which is like 110 billion. Then because the leverage ratio is 2, to get to the equity, you just cut that in half. So you divide that total assets by the leverage ratio. It gets you to 55 billion. And then now you knew what the net income was, and ROE is just net income divided by total equity, which gets you to the 20%. But I like the formula we did better because it's a lot more just like simple and easier to understand. So yeah, we already pretty much covered this this formula here. This just shows it in a way where you combine this expression all into the original formula. And one thing to say about this is that it basically assumes that there's like a long-term sustainable state of growth where like every year the stock is going to grow at the same amount in the future, which is pretty unrealistic in reality. So let's keep it moving to the next one. Question 3. So this one is going to test basically our intuitive understanding of these things. And so I realized that I'm blocking one of the questions. So my head's blocking the question. I'm going to rewrite C. I'll just scratch this out so that you guys can actually see this part. So C says the lower payout ratio. So the lower payout ratio and higher required rate of return. So that's what C says. So let's move into it. So in explaining the justified forward price to earnings ratio. So this is going to be the price per share divided by the earnings that we expect over the next year. And this is actually, when I manage stocks for my own portfolio, I actually look at the forward PE ratio as one of my favorite things to look at. And it's because it bakes into account the growth of the stock over the next year. So that word forward is so important because if you take out the word forward, you're just looking at the past year's earnings, which for like a really rapidly growing stock, like say, at this time, like Nvidia, the forward PE and just the normal PE are massively different because of the growth that's baked in. But anyways, in explaining the justified forward PE ratio, an analyst stated that the calculated forward PE will rise if an assumption is changed, such as assuming. So we need to figure out which of these three things, or it could be multiple, is going to cause the PE to rise. So this would be something that either causes the price to rise or the earnings that are expected over the next year to fall. And one thing I want to draw out really quick is the Gordon growth model formula one more time, and then we can derive it into the PE ratio. So remember, Gordon growth model is going to say that the price today should be equal to the dividend 1 year from today over the required rate of return minus the growth rate. So now we can divide both sides by the earnings next year to get a derived forward PE. All right, derived forward PE. And so now that we have that, we're going to see if we just divide both sides by the forward earnings 1 year in the future, it's going to be price today divided by earnings 1 year from today. That's our forward PE. Is going to equal, now we can take the dividend on the top, so that D1, and just divide it by the earnings 1 year from today. And then we can divide that whole thing by R minus G. Now, what is this ratio on the top? This is the amount of our payout ratio for the next year. So this is going to give us this little p here over R minus G. So we see that the forward PE ratio, this expression, so price today divided by earnings for over the next year, is excuse me, is equal to the payout ratio of dividends over divided by R minus G. So now with that in mind, it should be really easy for us to solve the this problem, and you'll see why. So let's get into it. So let's figure out which of these is likely to cause the PE ratio to rise. How about higher dividend growth rate than before? So let's just flow through this whole thing. So if we increase the growth rate here, then we've decreased the denominator. So if we've decreased the total denominator, then this whole thing should rise, right? Because we're subtracting it in the denominator. So we could just say this pushes up the growth rate, which then makes the denominator smaller, which pushes up the price, which is going to push up the PE ratio. So that does satisfy. How about the next one? Lower payout ratio than before. So this time we're going to lower this little p payout ratio. So if we lower that, that makes the numerator smaller, which makes this whole expression lower, which makes this lower. So we're going to say that that's going to lower price, which is going to lower the PE ratio. So that won't satisfy it. And then how about a higher required rate of return than before? So we're going to increase R. So if R increases, we've increased the denominator, which should lower this whole expression, which is going to push the price of this down. So once we put it into the formula, it's really pretty simple and straightforward. So we raise R, then that's going to push down the price and push down the PE ratio. So we can see that really of all these three, the only one that's pushing up PE ratio or making it rise is going to be the higher dividend growth rate than before. So that's A, which says only the higher dividend growth rate. And yeah, that's just a little bit of intuition. Let's move on to the next one. And I'm sorry, I'm seeing the comments in the chat, but some of them I do not speak the language of, unfortunately. Sorry about that. And let's move on to question 4. But I do appreciate you watching. I'm impressed of the. I wish I was bilingual. Man, it would be so hard to. I always thought it'd be so hard to take CFA. Like if it was in a language that was not my first language. It's amazing to me that people are able to do that. So let's move on to question 4. I see. The question says a firm's price to sales ratio, so we already talked about that a little bit on the first question, would most likely be higher than competitors due to relatively, and then we have basically three options. So we want to think of things that are either going to, so we have price per share, or we have sales per share on the bottom. And we want to look for things that are either going to say that the price per share should be higher than competitors, or the sales per share should be lower than competitors. So which of these three things would qualify that? So the first one says high leverage. Now, would that justify a higher price to sales ratio than the competitors? Well, what does a higher leverage imply? It implies that the risk is going to be higher. And so what is based on the risk? Well, we know that the required rate of return is based on the risk. So this would push R up. Again, I think I should draw out the Gordon growth model, which says our price today should be equal to dividend 1 year from now, and over R minus G. So we push up R. Once again, we're pushing up the whole denominator, which pushes down the whole value. So that should not justify a higher price. It should actually cause for a lower price, which should cause a lower price per sales ratio than the competitor. So we would eliminate A with that option. Well, how about a high assets per share value? So think about it this way. Let's say I just started a company last year where I have access to basically all of the world's most valuable diamonds. And I don't really have many customers or sales because I just started this business, but I started with a ton of capital and I was able to buy like all these natural diamonds or something like that. I would have very little sales because I haven't really sold much yet because I just got in business, but people would want to own this stock because I've got like all the supply of the natural diamonds. So that could justify having a higher price to sales ratio than competitors. That would make perfect sense in that case. And then finally, what about aggressive revenue recognition principles? Well, this would just result likely in a lower price to sales ratio because that makes your stock less compelling to own. It would basically cause a decrease, just like up here, I would cause an increase in the required rate of return, which then would eventually lead to a lower PE ratio, just like the other one. So we would settle on B as our answer there. And now let's move on to the next question. And let's see, I can't remember. Oh yeah, so here's another formulaic one, but this one we're getting into the price to book value ratios. And so we've been talking about price to sales, the price to sales ratio. Let's talk about what is the price to book ratio. So we're just given a bunch of information here with a bunch of values for assets, liabilities, par value of the shares outstanding, retained earnings, and price per share. So they're asking us, based on this information, what is the ending price to book ratio? So let's just talk about what that is. So the P to B ratio is the price per share of a stock over the book value per share of the equity of that company. So what do we have right now? We're given this price per share right here of 10. So we can just go ahead straight away and fill that in. How about here? Book value per share. We're not given this. So this is something we have to figure out. Let me put a little question mark there. So how would we figure out what is the book value per share? So let's start down here. Book value per share is going to be equal to the total book value of equity divided by the total number of shares outstanding. So which of that are we given in this problem? Well, we are given the par value of outstanding shares is 500,000, and it tells us that it's $1 par value for share. So if we just divide this by the, 1, that's going to give us 500,000 total shares outstanding. So we have that denominator value, but what we don't have is the actual book value of equity. So now how do we find the book value of equity? A lot of these are just like, they just chain and chain and chain onto each other like that. So let's go find the book value of equity is going to be equal to the value of assets on the book minus the value of the liabilities on the book, which is going to be equal to, which they did give us here. So that's that 4.5 million minus that 2.5 million, which is going to be just equal to a flat out 2 million. So now that we have that, we can just go back up and just plug along the 2 million into here. And now we find, since we know our book value of equity is basically 4, the ratio is 4, book value per share. So it's like $4 of book value per share of stock. Now we can go in to find our price per share divided by our book value per share, which is just going to be the $10 price per share divided by the $4 book value per share, is going to leave us with a price to book ratio of 2.5, which is one of our available answers. And this one it just requires like getting familiar with what these definitions are. And honestly, this one you could basically solve intuitively once you understand what the concepts are. You don't really need to know these formulas to even just work your way back to that answer. But when you're pressed for time on a CFA exam, like any little formula shortcut that you've mentioned does absolutely help a lot. And now we are on to another one that is going to be looking at the balance sheet. So let's take a look at this. The following table presents extracts from the balance sheet of some made-up company, a travel agency in USD. And now we see on the, we have basically, this kind of confused me when I was looking at it at first. So let me just draw a little line here and show you that this is assets and everything underneath is liabilities plus stockholders' equity. So, I just saw a comment. I see, hey Ryan, thanks for bringing the knowledge to the masses. Happy New Year. Oh yeah. Hey, it's my pleasure. And I get things out of sharing this too. So, it's not all pure altruism, but no, it does make me feel good to see your comments. So happy New Year to you too. So let's continue with this. So we see our balance sheet. The market value of all balance sheet items is equal to their book value. So that's telling us that this is not just we don't have to worry about converting things from market value to book value. It's basically just a simplifying assumption that whenever you see like something saying the market value of everything is equal to book value, it's just like this is an assumption that makes the problem easier to solve and less things that you actually have to consider. Okay, I see. Except for the market value of long-term debt. So that's going to be the one thing that what they have on the book is not an accurate reflection of the market value, which is 110% of the reported value. The company has 1,000 shares of outstanding, that should say stock, I think. And then based solely on the information given, an asset-based valuation will give a share price closest to. So this asset-based valuation is basically saying this. Let me just write it up top. So asset-based valuation. Let's see. It says that the fair value of the equity, so let's call it fair value of, I'll just say E, fair value of equity is equal to the fair value of the of the assets minus the fair value of the liabilities. And so we were given this thing that says all this stuff is basically its fair value. So now we just need to plug into this this formula to find this stuff. And we're told, all these things are accurate. All these things are accurate except for this one. So we need to adjust this up to 110%. So we can do market value of this is multiplied by that value times 100%, which gives us a market value of 35.7. Now here's the thing, at the end of the day, if you're doing an asset-based valuation, this common equity here, this is literally just a plug number that makes everything else tie out, because assets value need to match the total value of the equity and liabilities. So really the only thing that can change is this number. And how do we find what that number became? Well, we can use this formula here that says fair value of equity is equal to the fair value of assets, which we know is 100 because that did not change, minus the fair value of the liabilities. Excuse me. So what's the fair value of that? Well, we only have 3 liabilities, so we can just plug them all in. So 2.4 plus 5.1 plus the new value of 35.7. And once we add all those together, we're going to end up with a plug number that this value basically has to decrease to 56.75, which makes sense. If the liabilities increase, then the equity has to decrease, and that's one of our available answers for that. So I think the key important thing to realize or remember here is that when you see that word asset-based valuation, that you remember that basically you're just using equity as a plug number for the difference between the fair value of the assets and the fair value of the liabilities. And once you remember that, it's easy to work your way back to these type of the answers on these type of problems without actually like having to memorize too many formulas. And this answer just pretty much shows the same logic I just walked through. So now we're going to get into some, I think, that are going to be, especially now that we've gone through this logic, some of these are going to appear to be a little bit easier. So let's see, for this one, if an investor's required rate of return is equal to 12%, so that's just going to be our R. So, and a company's stock is $45, so the current price is equal to 45. Oh, sorry, I should call that P0. The next dividend, so the D1, is estimated to be 3.6. So let's just put D1 there. And the growth rate of dividends is equal to a constant 4.5%. That's G. This is really just like the most easy one. Then the stock is most likely, so we have to figure out, is it overvalued, undervalued, or fairly valued? So we want to basically figure out what is the value today. And again, we're using Gordon growth model. Whenever we see this like growth rate of dividends is constant, think Gordon growth model, which has this specific formula, which says that D1 divided by R minus G is going to be equal to the value. And I realize that I made it look like V is dividing something by, yeah, that's not a variable. I was just saying Gordon growth model. So there. Now, how do we find any of this information? Well, it's pretty much all just handed to us. I don't, maybe you might get some this easy on the test. I guess it's hard to say. It's been so long since I even took CFA Level I. I do feel like some of the practice problems were harder than the problems that actually showed up on the exam. So it's possible to get one that's this easy. And then so we just take the dividend for 1 year in the future of 3.6, divide it by that 12% required rate of return, and then subtract by that constant growth rate, 4.5%. We solve all that when we're going to get a price of 40 equal to 48. So now we were told that the current price is actually going to be 45. So 48, that's what we think it's worth, is greater than the current price of 45. So we're saying our intrinsic value estimate is greater than the price right now. So we would then say that this stock is undervalued because we think that it's worth more than it's really priced at. So that's a really simple, straightforward one. And I think the rest of them are going to be fairly straightforward, just like that one was. So this one is actually going to be a new concept, at least for this live stream, which we're going to be looking at a multi-stage dividend discount model where I'll draw out some of the cash flows on the timeline. So let's see this. An analyst forecasts that a company will pay a dividend of $2.30 next year. So we can just go ahead and write that's D1. $2.60 the following year, so the year after next would be the dividend at time 2. And dividends will grow 5% thereafter. So that's going to be our G. If an investor's required rate of return is 12%, so that's our R, the intrinsic value of the company in USD is closest to, and here we're given that value. So let's draw out an actual timeline of the cash flows. And I feel like these type of questions are represented, like there's a lot of like multi-stage DDM questions from what I remember. So we'll say right now here is the T0. Let me scoot that up so you guys can actually see it real quick. So that's T0, and that's going to be this timeline. Now we'll go 1 year into the future, which is we got T equals 1, which is going to be that dividend at 2.3, right? So we got that dividend time 1. I see another comment. I've got my CFA Level 2 results in 7 days. Scared as hell, LMAO. I know that feeling. I used to be so worried the days before I was getting my results, because if you think about it, it's like, man, I could have an additional 500 hours or something, or 400, well, however many hours you study of work if I just don't pass this. And once you get that email though, like there's not many feelings in the world that are better than getting that email that you like pass CFA Level 2, which is I guess the only better feeling, or one of the better feelings, is the email that you pass CFA Level 3 that hopefully you'll be getting next year. Okay, so now the next thing on the timeline is T equals 2, which is when we receive that dividend of 2.6. And then now, here's the interesting thing about these like multi-stage DDMs is that you have to basically think about the cash flow that happens 1 year after they stop telling you that. And we'll go through why that is, which is going to basically be T equals 3. And let's just walk through why that is. So we're trying to come up with a value today, which is going to be equal to that dividend at time 1 over the growth rate. So not the growth rate, the required rate of return. And then it's just to the amount of years in the future. So we need to discount this one back, this D1 here, back 1 year to get its value to here. Then we're going to add the next dividend, which is that 2.6, the dividend at time 2, over 1 plus whatever our required rate of return is, to the power of 2, because now this one actually has to be discounted back 2 years instead. Now, are we done? No, because right here at time 2, this is where our analysis stops, but we need to figure out what is a terminal value that's going to be based on a dividend, which we could call D3, that's going to happen 1 year in the future from this point. So we know our long-term steady state of growth is 1.5%, so we'll just take the previous year's dividend, 2.6, times that 1 plus the growth rate of 5%. And once we do that, we'll find that our expected dividend at that times 3, like we don't even need to solve for it. We just know that's the math. So then whatever this value ends up being, or if someone in the chat wants to tell me the value, that's fine. We'll then have to discount it back to, assuming we're at this point in time, what do we consider this long-term terminal value of those future cash flows that begin 1 year out in the future. And how we write that into an expression is that we're going to take basically we're just going to use that Gordon growth model that we've been using this entire time, which is we're going to take that dividend, which is going to be the 2.6 times the 1 plus 5%. So we get our dividend, and then we're going to divide it by the 1 plus the required rate of return. But now, because we're looking at time 3, or 3 years in the future, we have to put the expression to the power of 3. So this is one of those things where it's very, I feel like this is such a common thing to mess up, which people put like 2 here instead of 3. But you have to remember that this is basically happening 1 year out from the end of the analysis. So it has to be that oh, sorry, I'm literally messing it up myself right now. And that's why I think it's something that's messed up often. So this is going to be to the power of 2, because it's happening right here. It's funny because I'm saying this is something that, I'm saying other people mess it up. I mess it up, basically. So this is to the power of 2 because it's happening, this terminal valuation is happening at this time where we're assuming this, where we're valuing right here. So now let's plug all these in, which is just going to be 2.3. Now we're finding the present value of this one, which is just going to be the 1 plus the required rate of return, which they gave us, which is 12%, so 1.12, plus the dividend at time 2, which is 2.6 over that 1.12 squared. It needs to go back further, plus, and then we can just say 2.6 times 1.05 over the 1.12 squared, and that's going to get us equal to a value of, if you calculate all that, it's going to be 35.21, which is one of our available options, B. And it's a little confusing at first, but like once you get these down, it becomes really straightforward and very simple. So let's move on to the next one for, and here's the formula. You can see exactly how it works if you want to pause your screen or something. And then let's move on to question 9. So it says the website corporation has just paid a dividend of $2. So that's going to be our value at time 0, basically. So let's write down our dividend at time 0, D0. If the required rate of return is 12%, which is R, and yeah, that's annually. And dividends are expected to grow indefinitely at a constant rate. So as soon as we see dividends are expected to grow indefinitely at constant rate, we know it's Gordon growth model. So that should be our G. The intrinsic value is, so this one's just super straightforward. So remember, with the Gordon growth model, value at time 0 should be equal to the dividend at time 1 over R minus G. The only thing we're not given is D1. So we know that D1 is equal to D0 times 1 plus G. It's very straightforward. So that'll be 2 multiplied by 1 plus the constant rate of growth of 10%, which is just going to get us to a value, if my mental math is correct, of 2.2. So it should be 2.2 over that 12% minus that 10%, which should give us an intrinsic value estimate of $110 per share, which is one of our available options. So that one, probably easiest one we did yet. And I like those ones that fall into the category of the easiest ones we've done yet. So now we just have one more, which is going to be this one, question 10. So this one asks us, which of the following is most likely an assumption of the infinite period DDM? And again, once we see infinite period, think Gordon growth model, think the formula that value of today is going to be equal to the dividend 1 year from now over the required rate of return minus the growth rate. So let's see, which is most likely an assumption? So the dividend growth rate must be constant. Let's think, is that true? Well, look at it. There's only one spot in the formula to put it. There's not. It's not like the multi-stage dividend discount model where we can put different cash flow values where dividends grow at different rates over different times. It's an infinite period one. We have to assume that it's constant. So that should be, that's an assumption. How about the risk-free rate is greater than the dividend growth rate? Well, this isn't the risk-free rate. This is the required rate of return. Now, required rate of return has the risk-free rate inside of it, but then there's, risk premium. So we might say that R is equal to the risk-free rate plus any number of different risk premiums. So this model does ask us to make the assumption that the required rate of return is higher than the growth rate, because if it wasn't, then the denominator would be negative, which would make the value negative, which doesn't make any sense. How could a stock's value be negative? So if this said the required rate of return is greater than dividend growth rate, it'd be true, but risk-free rate, not so much. So that is not a true, real assumption. And then finally, we see the dividend growth rate must be greater than the required rate of return. So is this an assumption? This is just the inverse of what we said. So if the dividend growth rate, G, was greater than the required rate of return, again, this would be negative. This denominator would be negative, right? It's a negative value. If you divide anything by negative, the value becomes negative. Value can't be negative. So once again, this cannot be an assumption. That would actually break the whole model. So really the main assumption of Gordon growth model, amongst other things, is that the required rate of return must be ahead or higher than the long-term growth rate. So that brings us to the end of this thing. I wanted to just talk about a few key takeaways. And once again, my webcam head thing is blocking the sentence, but that's fine. I'll tell you what it says. So for those multi-stage dividend discount models, really, we just need to map the cash flows out. When do they happen? Once we find the cash flows, we put them on a timeline. We need the required rate of return. We discount all the cash flows back to time zero based on some discount rate and sum them up. That's the price. Basically, all these things fit into this exact frame of reference. Once you can find the cash flows, find the discount rate, discount back to present value, easy enough. And actually, that same logic applies to basically everything in finance. And I would think, as I've gotten more familiar with finance, when I was studying the CFA originally, I used to just really try hard at memorizing formulas. I would basically sit there and try to, with flashcards, and memorize formulas a lot. And that did help me, and it was a nice shortcut. But once I've gotten more familiar with it, and become more intuitive with these things, it's you don't even need the formulas, because you figure out finance is all just cash flows and discount rates, and there's different ways you can estimate the cash flows and the discount rates and the growth rates. But once you get all that down, it's why, I don't know, at a certain point I started to feel why did I memorize so many formulas so much? If I just thought more about the logic behind it, I wouldn't even have had to memorize it. So anyways, let's pretty much wrap this thing up. There's the sponsor of this whole live stream and a lot of the content on my channel is UWorld. They're a huge CFA prep provider. I'm in the videos. A lot of the videos, they have other instructors as well, but they cover all 3 levels of the CFA exam. If you look at that, use that QR code or that link on the bottom of the screen, you can find the courses, and I have my own discount code through them, Ryan25, which gets 25% off the courses. And the thing is, they have really good Q banks. So obviously I can vouch for the videos because I'm in the videos. But the other thing that I think they do really well is they have these question banks that really make you think quite hard about how you're going to solve any of these problems. So anyways, that should bring us to the end of this thing. I hope you guys all have a good start to your year, and maybe this can provide like a good reset for you if you've been like, I know some people start to crash while they're studying or burn out. You know, it's funny, where I work out at, there wasn't many people there in December, and now it's like completely filled to the brim with people. It's like the New Year's resolutions are full in effect, so maybe everybody can use that same motivation to help them learn all this information. But anyways, thanks for joining, and I'll be uploading some more videos soon, so I'll see you guys in the near future.